Something happened last week that I do not think most people caught. And I want to walk you through it because once you see it, I think it is going to change how you look at your savings, your paycheck, and everything you think you know about the US dollar. A friend of mine called me on Thursday. He runs a trucking company out of Ohio, 15 years in business, good operation. And he told me that this month, for the first time ever, his single largest business expense is not payroll, not insurance, not equipment. It is diesel. Diesel has eaten his payroll budget. He told me he does not know how much longer he can keep the doors open. And I told him, you are not going crazy. This is not bad luck. This is a system breaking down in a very predictable way. And the gold market is the one place that is actually telling you the truth about it right now. Gold hit $4,120 this morning. That is up $1,091 in 12 months. And it did that while going through the worst monthly crash since 2008. March was brutal. Gold dropped 23% in a single month. People called it a top. Some of them panicked and sold. And then last week it bounced right back. Do you want to know why? Because the people who actually understand what is happening, not retail traders, not day traders, I mean the central banks of China, Russia, India, Malaysia, and South Korea. Those institutions were buying every single dip, the entire time it was falling, because they know something my friend in Ohio is just now starting to feel in his diesel bill. The dollar's hold on global finance is slipping, and the rest of the world has already started moving away from it. Now, I pulled up to get gas here in Miami over the weekend, and it was $4.09 a gallon. I had to look twice. Called my uncle in Illinois. He is paying $4.19. That is California-level gas prices in the Midwest. People in Illinois do not make California money, and that number at the pump is not some random price spike. It is a direct result of the biggest energy supply disruption in recorded history, bigger than the 1970s, bigger than anything before it. And it connects directly to why gold is at $4,720 this morning, and why central banks everywhere are stockpiling it at a pace nobody has seen in decades. That is what this whole video is about. So, let us get into it. On February 28th, the United States launched military strikes on Iran. And within days, Iran closed the Strait of Hormuz. Now, I want to make sure everyone actually understands what that means, because I think a lot of people hear that phrase and it just kind of washes over them. The Strait of Hormuz is 21 miles wide at its narrowest point, guys. That is all, 21 miles. And through that 21-mile channel flows 20% of all the oil consumed on Earth every single day. 20%. Gone, just like that. The International Energy Agency described this as the greatest global energy security challenge in history. Not of the modern era. Not since the 1970s. In history, that is their exact language. The last comparable event was the 1973 oil embargo, and that one only removed about 7% of global supply. This is 3 times larger, 3 times. And Brent crude responded accordingly. It spiked to $126 a barrel at the peak. Oil production in the Gulf, from Iraq, Kuwait, Saudi Arabia, and the UAE combined, dropped by 10 million barrels per day. Qatar declared force majeure on all LNG exports. The Dallas Federal Reserve ran their economic model on this and came back with a number that honestly shocked me when I read it. The Hormuz closure is expected to lower global GDP growth by an annualized 2.9 percentage points in Q2 2026 alone. 1 quarter. 2.9 points. Now, here is where this connects to gold, and this is the part that most financial coverage completely misses, guys. When you have an oil supply shock this big, you get inflation. Not the demand pull inflation that the Fed knows how to fight. Supply destruction inflation. The kind where raising interest rates does not fix anything, because the problem is not too much money chasing goods. The problem is not enough goods at all. And when the Fed cannot fix inflation without breaking the economy, you are in a stagflation trap. And stagflation is the specific economic environment where gold has historically performed best, bar none. As of today, the gas price at the pump is near $4 a gallon nationally, and diesel is just under $5, up more than 130 from just a month ago. Every truck delivering every product to every store in America runs on diesel. Your grocery bill is going up whether you like it or not. And every central bank watching this unfold is drawing the same conclusion: hold more gold. Because gold cannot be disrupted by a waterway 21 miles wide. Now, I want to talk about the dollar because I think a lot of people are getting tricked right now by what they see short term. The dollar index is sitting around 100 right now. Earlier this week, it crossed above 100.2 on war news. And people look at that and think, well, the dollar seems fine. And I get it. In a crisis, money flows into dollars. That is a 70-year pattern. It happened in 2008. It happened in 2020. It is happening now. But guys, let me show you the actual 12-month picture because the short-term bounce is hiding something important. The DXY hit 110.2 at its 52-week high. It is at 100 right now. That is a 10-point drop from peak. On a year-over-year basis, the dollar is down more than 3.3%. In currency markets, that is a massive move. You just do not feel it directly because everything around you is priced in dollars. The World Gold Council, which tracks every ounce of gold moving through global markets, said it plainly in their February 2026 report. The downward trend in the dollar index is likely to resume after any near-term bounce. They called dollar weakness a key positive force for gold going forward, and they explained exactly why. U.S. equities are still expensive compared to European and Japanese alternatives. The so-called double reward for foreign investors, which is strong U.S. stocks plus a strong dollar at the same time, is fading, and fiscal deficits are accumulating at a pace that raises serious questions about purchasing power over time. And the fiscal situation is genuinely alarming, guys. The United States is adding between $1.8 and $2.2 trillion to the national debt every single year. The total is now over $36 trillion. And the interest payments on that debt are running over $1 trillion per year. Think about that for a second. More than defense spending, more than Social Security. The single largest line item in the entire federal budget is now just the interest on the debt, not paying it down, not investing in anything, just the interest. And every time a Treasury note matures and rolls over at current rates, that number goes up. When foreign central banks and sovereign wealth funds look at those numbers, what they see is a liability, not a safe haven. A liability that happens to pay a modest yield while the country printing it buries itself deeper every single year. And more of them every year are drawing the same conclusion: reduce dollar exposure, add gold. The IMF reserve data shows the dollar at 56.92% of global FX reserves. A decade ago, it was over 65%. That drift is slow, but it has been consistent, and it is not stopping. So here is the part of this story that I genuinely believe most Americans have absolutely no idea is happening. And it is not even that complicated once you lay it out. BRICS, you have probably heard of it. Brazil, Russia, India, China, South Africa. But BRICS in 2026 is not the same five-country group it used to be. They have expanded to include Egypt, Ethiopia, Iran, the UAE, Indonesia, and Saudi Arabia, tentatively. 11 full members now. Collectively accounting for nearly 30% of global trade. When a group that size starts making unified monetary decisions, it moves markets. Period. And here's what they're doing. BRICS nations now control approximately 50% of global gold production. China alone produced 380 tons in 2024. Russia contributed 340 tons. And between 2020 and 2024, the central banks of BRICS member states purchased more than 50% of all gold traded on the entire planet, more than half. Think about that, guys. The countries most explicitly trying to reduce their dependence on the US dollar bought more than half of all gold, traded globally over a 5-year period. That is not passive investing. That is a coordinated strategy. And what made that strategy go from gradual to urgent? I will tell you exactly what. February 2022, the United States and its allies froze approximately $300 billion of Russia's foreign exchange reserves, overnight, without due process. Someone in Washington decided those reserves were politically inconvenient, and they were gone. And every single central bank on the planet that was watching said to themselves, if it happened to Russia, it could happen to us. Because gold sitting in your own vault cannot be frozen by anyone. It is yours. No counterparty risk, no sanction risk, nothing. So they started buying aggressively. Global central banks purchased 1,237 tons of gold in 2025 alone, third consecutive year above 1,000 tons. The People's Bank of China has been adding gold to its reserves for 16 straight months. And in January 2026, Malaysia and South Korea, both of which had been completely inactive in the gold market for years, both quietly resumed purchases. Two countries that are also facing the brunt of the Hormuz oil shock made the same independent decision in the same month: buy gold. And on October 31, 2025, BRICS launched the unit currency pilot. Each unit is pegged to 1 gram of gold, backed 40% by physical gold and 60% by BRICS national currencies. It is not replacing the dollar next Tuesday, but it is the first functional step toward a trade settlement system that does not need SWIFT, does not need dollar conversion, and cannot be sanctioned by Washington. That is not nothing. That is the foundation of something. I want to explain stagflation as clearly as I possibly can because I think this is the concept that most people sort of recognize but do not fully understand. And understanding it is the key to understanding why this environment is so specifically dangerous right now. Stagflation is when you have high inflation and slow or negative economic growth happening at the same time. And the reason it is so dangerous is that the Federal Reserve has exactly one tool: interest rates, and stagflation requires two completely opposite things from that one tool simultaneously. Here is how it plays out right now. The Hormuz closure destroys energy supply. That drives up the cost of everything in the economy because everything requires energy to make, transport, and store. Inflation goes up. Now the Fed is supposed to fight inflation by raising interest rates. But here is the problem. Raising interest rates does not create more oil. It does not reopen the Strait of Hormuz. It does not fix a supply destruction problem. All it does is make borrowing more expensive on top of an already painful supply shock. So now you have rising prices and slower growth simultaneously. Cut rates to support growth and inflation gets worse. Raise rates to fight inflation and growth craters faster. There is no good option. That is the trap. The Fed held at 3.5 to 3.75% at its last meeting, 11-1 vote. Chairman Powell called the oil price spike a one-time increase in the price of a good. Now, I am not going to pretend I know more about monetary policy than the Fed chair, but I will tell you what the market said in response. By March 27th, every single rate cut that had been priced into 2026 was gone, and markets were pricing in a 54% chance of at least one rate hike before year-end. The 10-year Treasury yield jumped from 3.97% at the end of February to 4.46% by late March. The 30-year mortgage rate hit 6.38%. All of that, guys, on top of $4 gas and $5 diesel. Every household budget in America getting squeezed from multiple directions at once. And here's the thing that I really want you to lock in. The 1970s oil crisis, same general setup, smaller scale. Oil embargo removes 7% of supply. Stagflation follows. Gold went from $35 to over $800 over the following decade. The current situation has removed 3 times as much supply. We are starting from $4,120, not $35. But the structural dynamic is the same. Supply shock plus monetary paralysis equals gold goes up. Historically, that has been about as reliable as anything in financial markets. Let me tell you exactly what happened in the gold market in March, because I think understanding the mechanics of that crash is actually the most important thing for figuring out where we go from here. Gold hit an all-time high of $5,595 on January 29th. And guys, that was not even a surprise given the context. Gold had already set 53 separate all-time highs throughout all of 2025. 53. The entire year was essentially one continuous record. By the time we hit January 2026, the trade was absolutely packed. Everyone who was going to buy gold had already bought it, usually with leverage. The position was crowded. Then 3 things hit simultaneously. The dollar index spiked. Federal Reserve rate cut expectations collapsed completely practically overnight. And CME Group raised margin requirements on gold and silver futures by 30%. That last one is the one people do not talk about enough. When CME raises margin requirements by 30%, it means leverage traders have to put up significantly more collateral to hold their positions. If they do not have the cash, they have to sell. It does not matter what they think about the fundamental case for gold. They literally have no choice. So you got a liquidation cascade. Leverage positions getting flushed out, which pushed prices lower, which triggered more margin calls, which triggered more forced selling. Between 9 a.m. and 9:30 a.m. on March 19th alone, the gold order book saw a 98% collapse in depth. That kind of selling has nothing to do with whether gold is a good investment. It is mechanical, it is forced, and it creates an opportunity. Because underneath all those leveraged traders being flushed out, something else was happening. The central banks were not selling. The sovereign wealth funds were not selling. The institutions running 20-year reserve allocation programs were not selling. They were waiting. And the moment gold got down near 4,500s, which is the range where sovereign buyers have explicit allocation targets that function almost like automatic purchase programs, they showed up. The price bounced. And gold is back at 47.20 this morning. The thing that I find really remarkable is that even after that brutal 23% crash, gold is still up more than 44% over the past 52 weeks from its lows near $3,085. That is after the worst month since 2008. If the underlying trend had broken, you would not see that kind of recovery this fast. What you saw in March was not a trend reversal, it was a positioning flush. And those tend to create the best buying opportunities in any market. Here is a piece of the Hormuz story that I think American financial media is almost completely ignoring, and it matters a lot for understanding where gold demand goes over the next 6 to 12 months. Japan relies on the Middle East for approximately 90% of its crude oil imports. Most of that transits the Strait of Hormuz. South Korea gets about 70% of its crude from the Middle East and routes more than 95% of that through Hormuz. South Korea has already activated a market stabilization program worth 100 trillion won in direct response to this crisis. That is roughly $68 billion in emergency response money deployed right now. And China, which has been cushioned somewhat by large strategic reserves, is still seeing its already modest 2026 growth outlook come under heavy additional pressure. And here is the part of this that loops directly back to gold. When Asian economies face massive oil import bills denominated in dollars, their currencies come under pressure. To stabilize their currencies and maintain monetary credibility, their central banks need to hold larger foreign exchange reserves. And when they build those reserves in a world where the Russia precedent made clear that dollar-denominated reserve holdings can be weaponized by Washington, the calculation shifts toward gold. We already saw this play out in January 2026 data. Total central bank gold purchases were lower in January than the monthly average from 2025. But the buying spread across more countries. Countries that had been completely inactive for years resumed purchasing. Malaysia came back into the market. South Korea came back into the market. Two countries that are simultaneously facing the worst oil supply shock of their lifetimes made the same call independently in the same month. Neither of those is a coincidence, guys. And this is going to continue. The World Gold Council is projecting 750 to 850 tons of central bank purchases in 2026, even accounting for some slowdown from the 2025 pace. That is still historically exceptional. And the structural price floor it creates near $4,500 to $4,600 per ounce is not theoretical. It is built from the actual buying programs of actual institutions making actual policy decisions in real time right now. India is the other piece of this worth watching. India has the most acute near-term oil supply vulnerability of any major economy and has been pivoting hard toward Russian crude as an alternative. Every barrel of Russian oil that India buys in rupees is another barrel of global energy trade that bypasses the dollar system, which is another transaction that reduces the structural demand for dollar reserves, which is another marginal vote for gold as the world's non-dollar reserve asset. Jerome Powell's term as Federal Reserve Chair expires in May 2026. Kevin Warsh has been nominated to replace him, and markets have been calling this the Warsh shock ever since the nomination was announced. Let me explain what is actually going on here, because I think the simple hawk narrative misses some important nuance. Warsh has a long public history of hawkish rhetoric. He has talked about the dollar's scarcity value. He has emphasized balance sheet normalization. When his nomination became clear, markets immediately repriced. Every rate cut, priced into 2026, was removed from expectations in a matter of days. And then, CME Group hiked margin requirements on precious metals by 30% almost simultaneously. Those two things together, hawkish Fed narrative plus higher margin requirements, are a big part of why gold crashed so hard in March. Not the fundamental case breaking, the positioning getting repriced. But here is what the simple hawk narrative misses. The U.S. bond market is $51 trillion. It is the foundation of the entire global financial system. Any Fed chair who pushes monetary conditions tight enough to create dysfunction in the Treasury market does not end up fighting inflation. They end up triggering a financial system crisis that is 10 times worse than whatever inflation they were trying to contain. Warsh has been on the record expressing concern about destabilizing Treasury markets. And with the U.S. government running a $2 trillion annual deficit on top of $36 trillion in total debt, the room to genuinely run a Volcker-style rate hike campaign is extremely limited regardless of who is in the chair. The practical expectation is that Warsh uses hawkish language to establish credibility, while being constrained by the same fiscal realities that constrained Powell. Every Fed chair since 2008 has faced the same fundamental problem. The debt is too large to allow rates to stay genuinely high for long without triggering a debt service crisis. That problem has not gotten smaller. It has gotten much larger. Now, this Wednesday, April 8th, the FOMC minutes from the last Fed meeting come out. And guys, this is really worth paying attention to. The minutes will tell us how the Fed was actually thinking about the oil shock behind closed doors. Was Powell's one-time price increase framing the consensus? Or was there internal disagreement about rate hikes? Were their policymakers already discussing the stagflation risk explicitly? Any signs of serious internal division about the path of rates are going to move gold. And Thursday, April 9th, we get Q4 GDP and core PCE on the same day. If those two numbers go in opposite directions, growth down and inflation up, that is the stagflation print in real time. Before I get to the practical takeaways, I want to hit two things I have not covered yet that are important parts of this story. First, silver. Because almost all the attention in this environment goes to gold, and silver has been doing something absolutely extraordinary. Silver surged between 140 and 150% in 2025. Gold was up roughly 65% over the same period. Silver nearly doubled gold's percentage gain. It broke above a technical resistance level it had been stuck below for 13 years. And in just the first 2 months of 2026, China's silver imports hit 206.76 tons, the highest level in 8 years. And here is why silver is interesting in a way gold is not. Gold is a monetary metal. It responds to dollar weakness and safe haven demand. Silver does that too. But silver is also a critical industrial material. Solar panels, electric vehicles, AI data centers, semiconductor manufacturing. All of those industries consume silver as a direct input. So, when you see demand for silver rise the way it has been rising, you are not just seeing a monetary trade. You are seeing industrial demand colliding with monetary demand in a market where supply is genuinely tight. Analysts are putting out targets of $100 per ounce for silver in 2026 and beyond. Now the institutional targets for gold. Goldman Sachs is at $4,800 per ounce for their 12-month target. Reasoning, sustained central bank demand, and eventual Fed pivot to easing. Bank of America and JPMorgan both see $5,000. Yardeni Research, which does not normally make aggressive predictions, is at $6,000 by year-end. FX Empire projects a full-year average of $5,400 with a potential high of $6,150. And Goldman's bear case, the scenario where a comprehensive Iran ceasefire happens and the war risk premium deflates, puts gold at $4,100 to $4,200. Notice that even Goldman's worst case is not below $4,000. The structural floor is real. You know what is interesting about those targets? Even Goldman's base case of $4,800 implies gold is currently undervalued by roughly $80 from where it sits this morning. That is not a heroic assumption. That is just their 12-month view on where the structural buyers and the eventual Fed pivot take the market. The upside scenarios are more dramatic, but But even the base case says we are not at the top here. One more thing on the stock market side. Newmont Corporation, the world's largest gold miner, declared 2026 a quote trough year, unquote, and lowered guidance. Their stock got hit. But when gold recovers back toward 5,000, those same mines become extremely profitable very fast. The miners are the leveraged version of the gold trade, and they are worth watching. Okay, guys, I always try to end these videos with something practical because I genuinely think doom scrolling without any direction is just anxiety without a plan. So, let me tell you what actually makes sense to do given everything we just covered. Number 1, I cannot stress this enough. If you do not have at least 6 months of living expenses sitting in cash right now, that is your only financial priority. Nothing else. Not gold, not stocks, not anything. Because the job market is genuinely terrible right now. We covered a story a few weeks ago about a woman who applied to over 500 jobs in a year and still could not land anything stable. That is the reality for a lot of people. And if that happens to you and you have no cash cushion, everything else becomes academic very quickly. 6 months minimum. A year would be better given how uncertain everything looks right now. Number 2, look honestly at how much of your financial situation depends on the US dollar holding its purchasing power. Savings accounts, cash, bonds, all of that is denominated in dollars, and every single structural indicator we went through today is pointing in the same direction for the dollar over the medium term. I am not telling you to abandon the dollar. I am saying that having zero exposure to anything that holds value outside the dollar system is carrying a real risk that most people are not thinking about. Number 3, cut whatever discretionary spending you can before the oil shock fully works its way through the supply chain. Gas is near $4. Diesel is near $5. Everything shipped by truck is going to reflect that over the next few weeks. Your grocery bill is going up. Your utility bill is probably going up. The things you can control are the things you choose to spend on beyond necessities. Here is the bigger picture, guys. I have been saying for a while now that we were running too close to the edge as an economy. Too much debt, not enough savings, wages that have not kept up with what things actually cost. And something was going to push us over eventually. I did not know it was going to be the Strait of Hormuz. Could have been something else. But here we are. And the same message applies as it always has. Live below your means, build reserves, stay out of debt. And pay attention to what the smart money is actually doing with its assets, because the central banks of China, India, Russia, Malaysia, and South Korea are all telling you the same thing with their purchasing decisions right now. They are buying gold. They are not doing it because it looks nice. They are doing it because they can read a balance sheet. If you guys got something out of this video, make sure you are subscribed to the channel. Drop your thoughts in the comments below. And if you do not want to wait for my next video, check out this one right here on the screen, and I will see you in that one.